It's anniversary day today, but not a particularly happy one. 5 years ago today, French bank BNP Paribas suspended withdrawals from two funds related to subprime US mortgages. The ECB flooded the system with €95 billion, and the world was faced with the deepest financial crisis since the 1930s. I'm Jamie McGeever, and this is today's Market Pulse. So, how have financial assets performed in those 5 turbulent years? With me now is Mike Dolan, investment strategy editor here at Reuters. Mike, 5 years ago today, Deutsche Bank have a note out today analysing the performance of 40 assets over those 5 years. Some obvious ones, gold up, Greek stocks down, but there are a few curious ones in there. Let's start with the positive surprises.
I mean, for a start, I'd say using anniversaries in 5 years in terms of market performance is always kind of slightly riven with caveats because, it depends on the date you start, where's your market timing. But it's interesting to look at it nonetheless. The positive surprises, the big one is corn. The corn prices are the most spectacular gain, getting almost 150%. I think it's above everything else.
Most of that in the last few weeks?
Probably, yeah. But I think there's a story there beyond the credit crisis. So I suppose it's dangerous to use everything framed in those terms. But there's been several droughts. There's been the whole ethanol biofuels issue that has driven that over the same period of time. But I guess the other surprises would be the fact that fixed income generally. This is a crisis that was born in the credit markets. This was about debt. This was about holding defaulted paper and all that sort of stuff. But the universe that you'd wanted to have been in over that 5 years is fixed income, including, interestingly, that there's positive total returns on Italian BTPs and Spanish government bonds.
So Italian bonds and Spanish bonds, despite everything, if you'd invested in them 5 years ago today, you'd be in the money.
Absolutely. and also, high yield European corporate debt and high yields or junk debt in the States as well.
Why do you think that is?
I think the key thing here to remember is that over the long term, the fixed income for safety reasons. I mean, okay, if there's credit risk, then you get a default, and God knows we've seen that recently with the problems in Greece and what everyone is worried about. But by and large, it is a defensive play. You are going to get, if you paid back at par, you get a fixed return. That's the idea. Whereas in equities, the risk obviously is much greater, and we can see on the other side of the of the balance sheet, if you like, over the 5 years, all of that is in the equity markets, not just in Athens.
Just in Greece or Ireland, but China, Chinese stocks down about 50%.
That's probably the biggest surprise, I think. I think it's probably a well-worn statistic now that in 2011, the so-called BRIC markets underperformed the PIG markets, as they're known in Europe. You can argue what that's about: slowing global demand over time, a realization that this crisis is not located in the United States or in the Eurozone. This is a global crisis, a global banking issue. It will slow the world down, and to what extent these markets were already heavily priced for the opposite. It's worth remembering too that equity markets, if you date the crisis to August 9, 2007, equity markets actually reached their record high in November that year. It took a while for people to actually feel what the impact with this was, and a lot of people would have argued early on that the place to be was in equities because there was going to be a reflation of the world economy and that sort of scenario of inflation over time. Equity is the best place to be. That hasn't happened.
Didn't quite work out that way, and also oil hit its record high the following year, of course, in July 2008. Okay, that's where we were. Where are we now in terms of investor positioning?
Well, obviously, as you can tell from some of the performance stats, and particularly in the so-called safe havens of treasuries and bunds and the places that people have gravitated towards, and gold to a lesser extent, I guess. But people are hugely positioned in fixed income. If you look at our asset allocation polls, the most recent one that was in the end of July, it showed that on the series that we have, at least, the highest holdings of bonds globally by funds across the world since January 2010, when the euro crisis started to break out. So there's a huge herding into fixed income, particularly safe fixed income. And if you look at the Treasury auction, 10-year Treasury auction last night, where we had the lowest bid-to-cover ratio since 2009, you might think that while this crisis will last for some time, is the market already priced for 5 to 10 years more, and is that extreme?
Indeed. I'm just going back to what I was writing 5 years ago. On August 10th, 2007, mounting fears of a full-blown credit and liquidity crisis will keep markets on edge next week. An understatement there. Michael, thank you very much. Well, as we've just discussed, gold is one asset that has soared in value during the crisis. Our chart of the day comes from technical strategist Valerie Gastaldi of Day by Day. She says that despite a period of consolidation, there's still plenty of support under the precious metal.
We are very close to moving out of that pattern, as the trend has been rising previously, and that pattern is not a reversal pattern but a continuation pattern. We can expect gold to resume its move up. Now, nonetheless, we have not moved down to a 38% retracement yet, about 1548. So we could have, maybe in a week or so, we could have a fast fall to that support before gold rises again.
That's all for now, but keep up with us on Twitter @Reuters Insider and join us at this time each weekday for a snapshot of what's moving on financial markets and why. I'm Jamie McGeever, this is Reuters.